world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Today, Rebank co-host Aman and Ghei of Finch Capital connects with Steve Toland, founder and CEO of TransFICC, an e-trading technology company providing solutions for fixed income and derivative markets. Steve has over 25 years of experience working in the global capital markets. He was previously head of LMAX Interbank, led global sales for MarketFactory, and held the positions of head of FX sales for EMEA and America at ICAP, and head of sales for Americas at Thomson Reuters. Aman and Steve discuss why there hasn't been much innovation in capital markets infrastructure compared to traditional retail brokerage, and how trading desks at various product groups like fixed income are waking up to the new wave of API-driven technology to provide the best speed of execution in highly regulated markets. It's fascinating to think about how trading desks at big banks and asset managers will need to adapt to an increasingly competitive and technology-driven marketplace, and how TransFICC is building an API-first approach to solve these problems. For all of our past episodes and to sign up to our newsletter, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Steve Toland.
Steve, welcome to Rebank. Great to have you here. We're in for an interesting discussion today, primarily given the lack of innovation in capital market infrastructure and the backdrop of the last couple of weeks where, at least on the retail side, you've seen guys like Morgan Stanley buy E-Trade. But it's quite interesting why there hasn't been a lot of innovation on the infrastructure side, so to speak, over the last 20, 30 years. So really looking forward to this discussion, Steve, but maybe to set context, if you want to give the audience a little bit of a background about what you and do at TransFICC.
Yeah, well, man, thanks very much for having us on today. My name's Steve Toland, basically one of the founders at TransFICC. And what we're doing is we're building a hosted API translation service for banks and asset managers who basically trade in fixed income markets primarily, so bonds, swaps, futures, repo. And our technology enables them to build trading systems more efficiently and quicker, and hopefully help them innovate.
So, Steve, I'd like to dive right in. What's been the issue with capital markets over the last 20 years? Why do they move so slowly?
Well, that's a big question, talking about 20, 30 years. I think, don't get me wrong, there is, some good innovation going on in capital markets. So, and we're some beneficiary of some of that. We're co-located with Citibank in their innovation lab in London, which is not in the city office. It's in a WeWork environment, and we have great interaction with Citi engineers, and Citi have invested in us, and also Commerce Bank invested in us as well through their Mine Incubator investment arm. So there's we're beneficiaries of innovation that's going on. But that said, capital markets innovation is running at a slower pace than we see in other industries, whether it's healthcare or big tech, etc. And I think there's different reasons as to why that's happening. I think historically, if you went you talk about the last 20 years or so, I think pre-crisis, the banks were leaders of innovation. They were coming up with new products and implementing new technology, etc. But particularly, since 2007, 2008, that has slowed right down. And that is because banks are working on smaller budgets. They have a much greater regulatory burden to hit. If you're in a big organization which is shrinking and you've got to do all this regulatory stuff, people tend to be more protective of what they've got rather than thinking about how can I be innovative and do something different. So you've got some culture issues going with that sort of macro level thing with the banks that were traditionally the leaders, I think, of innovation in capital markets where we focus. It's interesting. I went to a talk last week by Ghei, led by Willis Bruckerman gave the presentation, but he was talking about you would expect that exchange operators would be leaders of innovation in capital markets.
You mean London Stock Exchange?
Yeah, the big exchange groups that there are globally, etc. There's some exceptions to this as well. CME released some open source code that we use called SBE. That's quite innovative, etc. And LMAX, where myself and my co-founders used to do some really innovative stuff. But that said, the Ghei presentation was making the argument that whilst you'd expect exchange operators to lead innovation, particularly in their market position, they're not doing so, largely because they're being very, they're either buying each other or being very protective of their own sort of markets and not integrating all their different technology platforms, etc., as much as you would expect.
Just to piggyback on that, why has that not impacted the retail side as much? So TransFICC obviously right now spends a lot of its time on fixed income. But if you look at the retail side, okay, you have some of the newer startups, the Robinhoods of the world trying to just, disrupt brokerage for instance. But even like the E-Trades, the TD Ameritrades, what's different about them from an exchange standpoint? Why have they been able to crack this as opposed to fixed income?
That's a good question. I think it's because it leads partly into the problem that we're looking to solve. When you look at a sort of a capital markets level and those types of exchanges, they're more mission critical in terms of the sort of the size of the trades. Yeah. And there's a higher, they're regulated entities in terms of what's being traded on the venues, et cetera. And then there's been a sort of a technology arms race, which has sort of taken place over the last 15 years with, algorithmic trading, et cetera. And, an exchange is publishing data rates of thousands of updates per second. That's different from the retail world. And it has fostered a whole industry of co-location and premium market data services. And it's quite interesting that these big exchange groups make nearly as much money from market data and co-location services as they do from actual trading brokerage. And so their world has sort of changed, and they've been beneficiaries of that, certainly. And they like getting those big market data revenues, etc. And I think in the retail space, they don't have some of those, if you like, technology hindrances or say barriers to entry, and so that enables that world to be, I think, a little bit more innovative and faster moving. And they're in a different space. They're looking to give retail investors access to markets, etc.
Got it. Coming back to TransFICC and where you guys come in, obviously you're connecting trading venues across fixed income today. How do you see the value chain in this space? Maybe for the audience, it would be helpful for them to understand why they need someone like a TransFICC.
It's not immediate or obvious of why you need, our types of service, actually, because you could almost argue that we're sort of plumbing or connectivity, etc. But it is actually extremely important. So the business problem we're looking to help banks and asset managers with, and some hedge funds as well, is the fact that when they're trading these fixed income instruments now, they really need to trade them electronically. Can't trade them direct peer-to-peer or through a voice broker anymore. They need to trade them electronically, and that's for three reasons. One is the regulatory environment. They need an audit trail. So if they've received a customer order, they've got to prove that they're not front running, or sure. They've got to prove best execution, etc. When they go to execute that order, there's huge fragmentation as to where they can actually trade. So there is, we think, like 130 electronic trading venues for bonds globally, and then there's a whole bunch for repos and a whole bunch for swaps and interest rate futures, etc. So we think there's more than 200 electronic trading venues in the world of fixed income. So you got to connect to all those, and then some of them is a technology issue for these market data rates. So if you're not trading through electronically via an API, you're at a competitive disadvantage to those that are. So you've got to connect to all these trading venues via APIs. And the business problem is that they're all different. So every single venue's API is different. And even where we've got a fixed protocol, fix is at best, we would say fix-ish. It's a sort of a defined standard, but everyone sort of implements their own version of it. And consequently, what that means for banks who we work closest with, if they want to code to an electronic trading venue, new venue from scratch, it typically takes them 3 months to do the work.
Wow.
To actually do all the coding, integration, and obviously this is mission critical stuff. It's, they've got to test everything thoroughly. It's very time consuming, and obviously there's an expense related to that.
And we're talking serious volumes here, right? Like
yeah. Obviously it's thousands of trades and millions of market data updates going through. And so that's the business problem. What we're doing is we are coding to those different exchange venue APIs, or OTC venue APIs, and then we are translating those APIs into a single normalized format. And that's both the data schema and the workflow. And so what that enables through our normalized API is a bank or an asset manager can sort of plug into us. And the idea is they don't have to worry that there's 200 different ones. They get one normalized version. And then we try and make that as easy to implement as possible. We've wrapped our API in Java code, Java client library, and we've now got a .NET version. They can actually take, the developer at the bank can take some sample code, and if they want to stream prices into a venue or consume some market data, they should be able to do that, in half a day rather than taking 3 months. So that's what we're looking to do, and try and make those APIs and access to those venues as easy as possible.
Got it. Where have you got the most pushback from? Because obviously you're working with some of the biggest banks in the world. Their trading desks, I assume, that are slow to move, as you said. So there's obviously a sales cycle question like there is with any generally enterprise software company and so on. But maybe a little bit beyond that, what have banks, asset managers, hedge funds that you talk to in this space been hesitant to do around this? Because at the end of the day, you are touching critical infrastructure for them. I think the API approach is a unique approach, particularly in capital markets. Obviously, that's been the way of distributing software over the last 5 years. The API approach has really been kind of a winner here. So it's great to see that kind of translating into capital markets. So how do trading desks think about you? And it just seems like a no-brainer that they need to do this immediately.
Well, yeah, at a high level, and when you present it on a PowerPoint, it almost is a no-brainer. It's like, well, okay, so that's going to save us some time and money, and we can connect to some new markets, etc. The problem is banks have established legacy infrastructure, which has been built over many years, often with incumbent vendors. Not only is the sort of primary systems for trading, but you have downstream systems for booking trades, managing risk, and so you have integrated systems on the bank side, particularly, and changing from what you have today to a newer, innovative architecture is not something you can just switch over, in one big bang. And you wouldn't want to do that because it would be too much risk. And typically some of the banks are under, they're also under longer term contracts. So they go, well, I want all this new stuff, but I can't, I'm not really in a position to take it until our existing contract ends. So that's sort of some of the issues that we face, and it's sort of like moving is hard. We're talking about changing, some of the foundations of a building, and people need to move out first, and then you need to do the work. And so the way we go about tackling it with the banks that our customers so far is basically segmentation, either by asset class. And looking at just some bond venues to start with, or some swap venues for certain customers, or workflow types. So one customer just wanted to start with market data coming from the brokers. One customer wanted to look at their dealer to client order workflows that they have, for venues like Bloomberg and Tradeweb and Market Access, etc. Right. So you can't eat the elephant. You've got to segment it down and sort of start small. But it's very important on the bank side to actually basically, you've got to look at this holistically. When you're trading, there's a whole bunch of downstream things which are going going to have to happen in terms of your risk books and settlement, etc. So it's not a project where we can just let's just flick this over and see what happens.
So who are the parties involved typically on the banking side? So I'm assuming that the trading desk team, so someone from the technology side over there, but do you need to talk to risk, compliance, all those people?
Yeah, all of the above. I mean, typically we start with trading desk heads, who are interested in connecting to either new markets or new functionality. Obviously, in the bond trading world now, a lot more trading workflows are getting automated. So, for example, instead of having a sort of request come in from the buy-side fund for, give me a price on this bond, they'll send a whole portfolio of bonds through, or a list, as they call it, and say, hey, can you give me prices on all these bonds? And then the bank needs to price them all up and send them all back. And they're doing that in competition. So typically desk heads will either want access to new markets or new trading functionality. That's where we start. And then we are typically dealing with lots of technology people who are of three camps, actually. There's people who are developers at the bank, people who are supporting existing systems where they bought, from third parties, etc. And then there's typically IS people who've got to sort of plug in, networks and cables and that type of stuff, etc. So we'll talk with, all those people on the technology side. And then there's the whole procurement process. Sure. and InfoSec security, and people want to understand how our systems work, etc., and it's not going to compromise bank security and that type of stuff. So it's a longer sales process, partly because of the nature of the markets. Yeah.
Got it. Coming back a little bit to the market, so we spoke initially about equity and retail, and obviously today you're focused on fixed income, which is probably magnitude bigger than the equity side of things. What's next from, I would say, the product perspective, if that's the right way to say it? Are you thinking about different types of securities? What do banks want? And who are the big players that are really moving the needle for you on not only from a potential customer standpoint, but from an innovation standpoint?
So market-wise, obviously, so we decided to focus on fixed income partly because it was behind the curve electronic trading wise versus say equities or FX where we used to work. And partly but that's because some of the market is, some of the instruments are less liquid. So there's a reason it's not as automated as other markets. But that said, largely driven by the regulatory need, all those markets have got to go totally electronic, because we saw a big opportunity to sort of get in on the ground floor of the sort of, automation side of things. In terms of markets, so we've started in what I would call the rates world. So this is, government bond trading side of things, and then interest rate swaps. But we're now, customers are saying, can we do more in the credit space? So this is like corporate bonds, et cetera, which are less liquid. But again, there's a lot more venues have sort of sprung up which offer all-to-all access, where basically, both banks and the buy side have equal access to that market, etc. So there's some needs sort of in the credit market space, and then it's actually quite interesting, the repo market, and we haven't actually started on repos at the moment, but the repo market is absolutely massive, mainly done on a manual basis at the moment, and that due to regulatory needs which are coming in. There's SFTR regulation which is coming in later this year, and then something next year called CSDR, and I can't remember off the top of my head what those acronyms stand for. But they are mandatory. Banks and asset managers need to abide by that regulation. They need to report something like 114 fields they have to report electronically for SFTR that's just coming in. Someone can't write those tickets out, manually. That's all got to be automated electronically. So that's where we see, what's happening market-wise. And then there's also a structural change which is going on in the fixed income markets, where it used to be that sort of the banks sort of stood at the center of all the trading. If a buy side wanted to trade a bond with effectively another buy side, they'd always do it through a bank who'd warehouse the risk. Again, due to the changing regulatory environment and capital constraints, banks can't do that anymore. So there's a bigger need for asset managers to trade directly with other asset managers. And that is a change in market structure, which is also essentially driving change.
Because the trading desk at banks has changed dramatically, right? Even from a cost perspective, I guess over the last couple of years, you have seen dramatic cost reduction at these trading desks, and that's where someone like you would potentially come in and say, "Hey, we give you the ability to ride this wave of improving your cost income ratios at the same time delivering to your clients. I guess to your point, there's obviously this emerging alternative asset manager that can hire the best technical people and can do this directly. On the bank side, who are the big dogs here? Are they typically the similar names that you would associate with the biggest banks in the world, or are they different?
It's the names that you would expect. So the sort of top 10 global trading banks, sort of have the biggest sort of dominant position. And that's largely that's in the fixed income market that sort of works top down. So in most economies, they have a sort of what they call a primary dealer market. And so when the country issues debt, they only sort of trade it directly with, an appointed number of dealers. So in the UK, there's 16, and they are top tier investment banks, household names, etc. And then when those banks then sort of trade downstream, they go to, regional banks, or they go direct to asset managers, etc. And so you have this sort of cascading sort of effect. So the bigger banks have a bigger footprint and a bigger need to connect to more venues, etc. So that's sort of how it works.
Got it. So maybe coming back to TransFICC, where are you guys today? So you have some of the biggest banks in the world on your cap table in Citi and Commerce. What's next for you? How do you see the next 12 months, 18 months evolving?
Well, it's scaling up. So we're now up to, we've got 5 bank customers, and we've also got a market data customer. But those 5 bank customers are all, essentially they've got the same sort of longer term goals. They want to sort of build out their complete e-trading infrastructure, and they want to automate more of what they're doing, whether it's how they price their customers or building auto negotiation engines to negotiate with their customers on their behalf, etc. So there's been a lot of sort of working with some of those banks to make sure we've got the sort of the product fit right, and it's sort of, it scales, and it's very supportable and open and transparent. So there's been a lot of design work that's gone in with some of our key supporters on how the product's going to work. And it's obviously we're now in production with sort of several venues. The issue is that there's 200 venues. So we've got to scale our team up. We're currently at there's 14 of us, but over the next year we want to double the size of the team.
How many venues do you cover today?
So we're just up to 20.
Oh,
now.
Wow. Okay. So there's a lot.
But there's still, a way to go. But what we've been doing is we've been doing the most difficult ones. Yeah. So the ones that have got the most complex workflow, in terms of trading some of this request for quote workflow for European government bonds. And we're doing obviously credit work now. And then we've also been doing some primary dealer venues where they don't use, I mentioned fixed protocol earlier, but there's some venues that use these, what you call proprietary or binary protocols. I mean, they're difficult to code to. If you think about different API languages, if the analogy was like, an English person trying to learn Chinese and Japanese, or Russian Cyrillic. I mean, they're that different from the English language, and that needs translating. So we've been tackling some of the most difficult venues from an engineering perspective, etc. So we're now in a position where the core system is built. So the sort of, if you like, the scaling is easier, and also the speed of adding venues is going to go sort of a lot quicker, because we're, a lot of the core engineering issues have been tackled so far.
Got it. I want to finally come back to a point that we touched on a little bit earlier, which is around APIs, and why you believe this is the right approach in this market, because you could have very easily been a non-API company, which is fairly traditional in the capital markets infrastructure space.
Yep.
So what was your thinking around this approach to building software in capital markets?
I'd actually sort of come across it from the FX world, and saw that this common API approach just made it easier. When I was at LMAX, I was having trouble getting banks to plug in, because they said, well, hey, back to that problem. It takes us 3 months to do the coding work, and until you've got more liquidity, we don't want to prioritize it. So we needed solutions to basically make it easier to get people to plug in. So that's sort of where we started from. Why the API world is so important to focus on is, as I mentioned, to drive innovation for those banks, they need to change out legacy systems. And it's very difficult to change out legacy systems unless you have common points where you can sort of chop and change things out. And the API is a very sort of clear boundary of sort of like where one system starts, and another system sort of ends, etc. And so it makes it a much easier for a bank to transition legacy systems and components to newer systems and technologies that they want to put in. And so we think focusing on that API area is sort of mission critical. And if we can make that as easy, for banks to implement as possible, then we're going to, help those banks and asset managers and also vendors that they want to work with. We meet lots of vendors who are building some pretty cool stuff, in terms of the analytics world or risk management world, but they go, but it's actually got to plug into some venues at some point. And so, if we had a common API, it would make things much easier for us. So that's why we're focusing on the API space.
And do you think the exchanges wake up in this space here? Because it just seems an obvious thing. Maybe I'm overthinking this a little bit for them to do, to move away from traditional equities, to start thinking a little bit more about fixed income. How do you see that evolving? Do they work with someone like you? Do they start building some of their own infrastructure?
I mean, all the execution venues, whether they're regulated exchanges or OTC venues, like I mentioned TradeWeb and Bloomberg and MarketAxess, we've got great relationships with those guys. Partly because when they do want to innovate, they're sort of on the other sort of side of the trade. They've got banks who have plugged into their older API, and when they say, "Oh, we've got something new," we've got a new feature or function, they want their customers to upgrade. And so usually once those venues understand what we're doing, and we said we don't charge on the exchange side, so they're saying, all right, well, if you're going to make it easier for people to either plug in or upgrade, then why wouldn't we work with you, etc. So we've actually found the relationship with most of those venues pretty good.
Got it. And actually on that, how do you make money? Is it based on venues? Is it?
We charge. So our model is a SaaS model. It's a hosted infrastructure which can either be in the cloud or like an Equinix co-location center. If speed or security is important, and we charge sort of a license fee per venue per month. So we don't charge based on tickets or numbers of trades. The bank sort of has a clear idea of like, well, this is what it costs to connect to these venues, and it's fixed.
Got it. Very interesting. Great. Steve, it's been wonderful having you here, and I'm sure we will look forward to lots of exciting things in the capital market infrastructure ecosystem in the coming years to come.
Well, thanks very much for having me. I've quite enjoyed it for a first-time podcaster.
Fantastic.
Thanks for tuning into Rebank. If you liked today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.